afternoon, everybody. I'd like to welcome you to the halftime talk, and I'm delighted to be joined today by Dave Ernsberger, Global Head of Pricing and Market Insight at S&P Global Commodity Insights. Dave, thanks so much for joining us.
Thank you, Diala. It's such a pleasure to be here, and there's, as ever, no shortage of things for us to talk about.
Absolutely, and we're going to be trying to focus in our angle today in our talk on volatility that we're seeing in the oil markets, which has not assuaged in the last 2-3 months. That has been the name of the game, and we want to kind of talk a bit around that, what's caused it, and what would need to happen, if at all possible, to bring back normal levels of volatility, let's say, to the energy markets. And if it doesn't resolve itself, what is at stake in your opinion? So let's just start sort of with a 5,000 foot view and just ask you, generally speaking, in the energy markets at the moment, given everything that's happened with Ukraine, with Russia, post-COVID scenario, the IEA called the current global energy crisis in the last week or so the worst in history, and we've had our fair share of energy crises in the 20th century. Would you agree with that? How serious is this volatility and demand supply uncertainty?
Thanks, Diala. There's a lot to think about there in what you just introduced, and the current profound concern around volatility. And I guess where I would start by way of thinking about this today is, what is it exactly that people are thinking of when they say that the market is volatile? When the IEA says it's the worst energy crisis in history, or I sort of paraphrase there, and when OPEC talks about volatility being a concern, what is it people are talking about? And when I think of, I would look at it this way: when I think about all of the markets that Platts assesses and covers all around the world, we've certainly never seen so many different markets demonstrating volatility all at the same time like they're doing right now. It's not just gas in Europe or crude oil out of Russia or gasoline in the US or jet fuel in Singapore. It's actually all of those things, right? And then there are many more markets beyond that: iron ore, coking coal, container rates, right? So I think that the signature theme around volatility and what makes it sort of unique in our lifetimes right now, and possibly in history, although I think it's risky to say something like that. It's always risky, right? But the signature theme is that all of the commodity markets we cover at Platts, all the commodity markets people are trading in there out there in the world, all of them are volatile at the same time. And what does that mean? It means that there's no alternative. If you're in the gas market, you can't find an alternative in oil. If you're in the coal market, there's no alternative in gas. So for me, the issue around volatility is universal volatility, or near universal volatility, which means there's nowhere to go for comfort. There's nowhere to go for relief. There's nowhere to go to switch. And I will add one more thing, Diana, you want to jump in on it, which is, then if you look at any particular market, there are at times within each particular market historic levels of volatility. I was looking at a chart of nickel sulfate prices just this week, which is not a market I look at a lot, but it's an important market for battery metals, and it's interesting. That had a historically volatile year this year too, right? So every market you look at in its own right is experiencing historic levels of price movement, and then across the entire spectrum, there's nowhere to find comfort.
Yeah, and of course, you got sort of, to an extent, fundamental supply chain issues, a sort of hangover from COVID, but then you've got also the lack of liquidity, which is accentuating the volatility, and of course that lack of liquidity is coming from all the change in macro policy that we're seeing. So as you said, it's all compounding together, affecting energy markets and products and other markets, other commodities across the board. Let's talk a little bit about solutions to that, or what the outcome could be going forward as we progress towards the end of this year. OPEC, obviously a main player in the energy markets in terms of crude oil, and they came out with a decision a week or two ago, which kind of surprised the market, by announcing a cut of more than was expected to be announced, maybe not practically speaking going to be implemented, but still, an organization that said everything it's doing is to try and tame volatility, and yet their decision was seen as quite disruptive. Do you think they just, why did they do that? Do they have absolute confidence in this demand destruction that we're expecting?
Well, It's very interesting. Before we come to the OPEC decision, by the way, oil prices have fallen since then. So, fears that the market would spike or be volatile as a result of that proved to be not particularly well
So
founded.
they were proven correct because they've fallen on the back of supposedly demand expectation.
Well, they've fallen for a number of reasons, and that's certainly one of them. I'm not going to go all the way and say OPEC was proven to be right. Maybe they were proven to be lucky, but there's a whole other podcast we could have about that. But to come back to your question, which I think is really, really important around solutions to this situation. There's the core driver for all of this volatility that we're seeing, in my personal opinion, is chronic underinvestment in two things, and this needs to be done in every industry that we look at. One is capacity, the other is storage. I've been looking at commodity markets for 26 years, which makes me a young pup through the eyes of some and an old man in the eyes of others. But I think when you've done something for a quarter of a century, you've had an opportunity to sort of see a few cycles come and go. And I would put the politics to one side. That's a real thing, by the way, but let's put it to one side for a moment, because geopolitics has always been there. And I would put aside the competing interests of producers and consumers, because that's always been there. What is not here today that's always been there in the past? Capacity and storage. And that's not the same thing, right? Now, living in the UK and working out of here, when people calm down and stop talking about politics, occasionally they have a moment of introspection about the commodity markets. And the decision to shut gas storage capacity here over the last 10 years is really hurting the UK. Gas storage is virtually full in continental Europe right now, but they won't last the winter in continental Europe if they continue to draw down stocks if the weather gets cold, right? And the core point there is there's not enough storage capacity, and storage capacity is not a particularly sexy thing to try and sell to an investment community. The returns are not always amazing. It can be kind of its own kind of volatile market if you operate storage capacity. Now, the other kind of capacity I'm talking about is supply and demand elasticity and supply capacity. And that's where actually I think the most important thing about the OPEC decision when you think about the oil markets, and again, I put the geopolitics to one side, is what has been the outcome of that decision? Well, in fact, OPEC has restored 1 million barrels a day of production capacity that it can bring to market in the future if it decides that it needs to do that. If there was a phone call from a more popular US president to OPEC and to Saudi Arabia in the future saying, can you please release some oil? The situation we were in before this cut was there was no extra oil to supply.
Yeah.
And that's a bad place to be for volatility. It's a bad place to be for the market. So actually, I think if OPEC had said, we're doing this so we can have some reserve production capacity in case we need it in the future, that would have been a much better message than what they came out with in their statement. Personally, that's my view on it anyway. So production capacity, storage capacity, these things to do. And of course, and the last thing I'll say about that deal is the investment climate against investing in fossil fuels and hydrocarbons means there will only be pressure on capacity in the future from traditional fuel supplies. And we're going to pay the price for that for as long as we're unable to migrate to alternative fuels in the meantime.
Yeah, and I mean, you mentioned that OPEC didn't come out and say it, but many people have analyzed their decision as, they don't, Saudi being the primary member there doesn't want to be in a situation where it has no spare capacity. So in that way, the move you did was probably quite cautious. Let's talk a bit about, you touched on the US President Biden and his very recent comments today and last night, possibly, again, looking a bit desperate in terms of, telling oil producers in America, stop giving, dividend returns to your shareholders and please invest and continue to produce, literally calling on them to do that. I mean, is that really going to have any immediate effect anyway on prices and capacity? We've had high prices all year and we haven't seen shale producers move with that advantage. Where do you see that going? And in tandem with that, I wanted to keep you a little bit on OPEC to say, will OPEC do whatever it takes to defend what they can around the $90?
Yeah, so taking those two things and thinking about them a little bit separately, but then in relation to each other, the commentary out of the executive office, the US presidency, whether it's Biden, Trump, Obama, or anybody else, it has typically very limited near-term impact on what happens in the commodity markets. The commodity markets in the US, oil and gas production included, are driven primarily through private investment. Of course, local and federal regulations have a role to play systemically. But the exhortation of a president, whoever that president is, to do more, to do less, to raise, to decrease, has very, very limited near-term, medium-term impact. Policies have impacts, and actually, if you dig into the policy debates or the midterm elections that are coming up, there's significant and important policies that I think some candidates will be running on that will have an impact, but even those will be medium-term impacts, frankly, on the energy industry. So the only short-term impact that all this bully pulpit stuff will have is actually on the, maybe 1 or 2 percentage points on the midterms themselves, and it's more about the elections than it is about actually energy outcomes, I would argue. And like any leader, the president of the United States needs to be positioned on an energy issue in a way that will appeal to the electorate. But the actual economic outcome, probably pretty small, because at the end of the day, shale producers still bear the scars of not having been, let's put it in air quotes here for people who can't see this, fiscally responsible in the past, and they're pretty determined to be fiscally responsible in the future, not least because their shareholders demand it. So that's the U.S. side of things. The U.S. president has to be seen to be being tough on these things when people are hurting at the pump, and that's all about the election, I would say. On the OPEC side, I think OPEC will do whatever it takes to protect $90 a barrel, and that's where it has itself up a tree a little bit, because the risk of overcorrecting, oversteering, overcooking this market as let's call it an alliance of producers is very, very high in a world of such unpredictable, uncertain near and medium term economics around the global economy and demand side responses. And of course, there's always the shadow over OPEC of, are they doing this for the OPEC membership, or are they doing this for the plus membership of OPEC plus? Because if they seem to be doing this for Russia, things could come falling apart very quickly.
Yeah, well, let's talk a bit about Russia. A lot is always being talked about that, but let's talk about the impact on the actual energy flows that the war in Ukraine and the policy from Russia and the reaction to that in terms of sanctions from the West has had on energy flows. So far, we've seen obviously the obvious impact of that. Russian crude is still flowing, perhaps in different directions, towards the east, where it can get to and where it can be bought, and obviously at being offered at good discounts, so being bought up quite enthusiastically there. But these changes in flows that we're seeing, whether it's on crude, and then of course on products as well, because of demand in Europe and because of the gas crisis, etc. Do you think that's adding to the volatility that we see in pricing, or or is it helping in terms of reassuring that crude will flow where it needs to?
Yeah, I think it's both those things, Tiala, and I hate it when I listen to a podcast and somebody says yes to both, but I'll tell you why I say it's yes to both those things. So on the one hand, it's adding to volatility because there are a number of legal sanctions that apply to procuring and consuming Russian hydrocarbons. Then there are a number of voluntary prohibitions that apply to procuring and using Russian hydrocarbons. And the confluence of what is a legal requirement, what is a voluntary requirement, how does that affect the spot market? What can I trade in the open marketplace? That question has rarely been as foggy as it has been this year because of the confluence of changing statutory requirements on the one hand. Remember, every country has its own rules, right? And then on the other hand, multinational companies, state-owned energy companies, their policies are shifting all the time as well. So the spot market, which ultimately is where the value of these commodity markets is defined, is roiled by that kind of combination of ever-changing mosaic patterns of statutory and voluntary requirements around hydrocarbons. So that's adding to volatility without a doubt. However, on the other hand, Russian energy has moved very efficiently at quite a bit of cost to the Russians, by the way, not that they've volunteered to do this, but they've had to pay the price for it, away from European markets and towards South Asia and Northeast Asia, particularly India and China, of course. And that's been a relatively efficient move that actually has kept the markets relatively stable. I'm not suggesting they did anybody any favors there. It's just that the economics of arbitrage mean if Europe is consuming more West African, then India will consume more of the Russian. It's not quite as easy as that because of different qualities and different blends and all those sorts of things to think about. But the arbitrage markets have proven to be pretty flexible, and they stopped. I would say they stopped the oil market from being completely in meltdown this year. When you look at the commodity markets,
Yeah.
usually the oil markets are the ones that everybody's upset about, but actually the oil markets look pretty tame by comparison to a lot of other commodity markets, and it's because it's a seaborne trade driven by arbitrage, and that's actually keeping things pretty balanced. Now, in the long term, I think Russia's probably selling about as much oil and gas to Asia as it will ever be able to do. So the question for Russian energy is, well, how would they ever sell more? Because I don't know that China and India can particularly take too much more.
And what about even their capacity to sell what they're selling today in a few months' time, as sanctions continue to bite in terms of, parts and technology and access to what they need to keep their production going? There's been a lot of talk about that hasn't really hit yet, and in the first quarter of next year onwards, you'll really see that bite. And nobody's fight for this war.
I think when the clock rolls over on a year after the invasion, Russia will be looking at a bit of a cliff edge event around its commodity markets. On the one hand, sanctions will have fully kicked in at that point in Western Europe. I'm talking about early next year. And I don't think they'll be able to shift around 2 million barrels a day of their oil and even more of their gas, frankly, if that begins to come into play a little bit for that conversation. We'll see where that goes. And then on the other hand, as you say, the actual breaking down of the industry itself and the inability to procure technical parts and materials to keep the industry running on a mechanics basis will begin to kick in as well. So I'm not an engineer, as your viewers will be quick to point out, but you look at where the sanctions really hurt. That's where it really hurts something. So there's a bit of a cliff edge coming for Russia potentially.
Do you think, okay, great, Dave, let's move a bit on to gas. I mean, obviously that has been the main concern in Europe, at least in terms of supply and prices. Obviously last winter, without a crisis in Ukraine, we had spikes in gas prices and gas to oil switching, etc. In terms of demand for sort of gas to oil switching in the immediate sense, I mean, a lot of people say Europe is well stocked on gas for this winter, but is there any risk of volatility coming into the oil price from that in the next few months still, or has that been baked in?
I don't think there's huge risk of volatility in the oil price coming because of gas market developments from a switching basis. But a couple things about what you just said there, Diala. Europe needs to be careful because it might think it's well supplied going into, we're sitting here talking in late October. The market looks well inventoried, well stocked going into November and December, but a cold month and we could be in real trouble in Europe. So I think European policymakers are extremely well aware of that. If you look at the discussions going on in Brussels around price caps and market intervention, I think that January is the moment of truth for the European market if we're going to get out of this winter or not in good shape. And Diala, nobody knows. But there's enough inventory to get us to Christmas, and I suppose that's something to be grateful for. But where the volatility might come from is that gas prices shoot through the roof again, and your viewers may or may not know, but they've fallen by about 60% since their peaks just about a month or two ago. If they do shoot through the roof again, that can have outsized impact on refinery margins. Refiners are big users of natural gas actually in their own ways, and they're exposed to that in their processing costs. Particularly for desulfurization, and that ultimately could drive up diesel and potentially even gasoline prices again. So again, headline crude prices might look like a poster child for stability, and OPEC could be, again, unhappy perhaps that prices aren't at $90 a barrel for crude oil, but I wouldn't be surprised at all to see middle distillates prices, jet fuel, diesel back at the near $200 mark, and that's a big issue for consumers of those products.
And is that to do with sort of refining capacity or to do with demand, would you say?
It's to do with the cost of running a refinery economically. So, refinery margins have been historically high through 2022, but the refinery costs have also been historically high through 2022.
Okay, let's talk a bit about Asia, because that's where a lot of the demand comes from still. And now, but of course, it's taken a big hit, particularly in China. And other even emerging Asian economies. A lot of people now are saying China is never going back, not in the next decade anyway, to the growth rates that we saw. Putting COVID policy aside, that the whole economic policy has shifted, not only on corporates and different sectors, but there's a whole new sort of outlook on the service economy, etc. So give us your take on what the industry is thinking. Can it continue to rely on China to sort of be the savior of, let's say, oil demand? And also, how does their energy transition plans play into that, and how serious are they?
Fascinating, coming out of the tail end of the party Congress in Beijing and what's been going on there around the alarmingly long speeches that appear to be getting delivered in Beijing. Every Congress, they appear to be alarmingly long speeches, especially for people that need to try and figure out what they really mean. So it's a fascinating question right now, because it looks like as Xi Jinping enters a historic third term as the leader of the country, that Xi Jinping's approach to all of these questions will become firmly entrenched, and they appear to be significantly very different to the economic growth policies that were put in place by Deng Xiaoping and successors. And there are many experts that can go on about this in a lot of detail. But observing from a long way away, and I worked in Asia for a while, so I take a lot of interest in these things, it looks to me like China is absolutely going down a different road, willingly or not, around economic growth for the next 5 years or so, where it will be a lower growth economy on the one hand, and will be more energy diversified on the other. One thing that's been consistent about China for the last 30 years is an obsession with not being dependent on imports, and an obsession with not being dependent on foreign suppliers of anything. And I think that in the end, there was always an outcome, no matter who was running China, where the country would try and wean itself off of natural gas, crude oil, iron ore, if it possibly ever could. Anything that it needs to import to keep the economy going, China wants to wean itself off. And that's the tremendous opportunity that China has just on the horizon. If it moves towards solar, wind, and other renewable forms, there are big challenges of that migration, by the way. We're not necessarily massively bullish that China will be able to replace all of its energy with renewables, even if it wanted to, and even if that's great for the environment, because it's very difficult to run those kinds of energy systems from a resources perspective and an impact on water and lifestyle perspective. Nevertheless, China will definitely be looking to move as much of its hydrocarbon dependence onto renewables as it possibly can. That's going to dent future oil demand growth out of China. And the economy looks like it will be growing more slowly for some period of time to come than it has been in the past. It's still growing pretty well compared to the country I live in, by the way, but it'll be growing a little slower than the oil markets have been used to for the last 15 years. The oil markets are as addicted to Chinese growth as they're addicted to Middle Eastern supply, no doubt about it.
Okay, so let's look forward a bit more then, and this sort of whole debate around peak oil demand, that keeps shifting. The IEA shifted its forecast from, I believe, 30 to 25 to 30, etc. That it keeps getting stretched further beyond. Where do you stand today on how the market is looking at where peak oil demand dates, if you like, given what we just talked about?
Yeah, we generally. Sorry, Jill. I mean, we generally haven't seen oil demand peaking until 2034, 2035 in most of our projections anyways, because a huge amount of the capacity that comes on stream around renewable power and alternative energy solutions, and unequivocally, we need all of that to help manage both the environment, but also future populations and their opportunity to secure affordable energy solutions. We need all of that. But the most ambitious growth projects, including China's around renewable energy, will only really meet incremental demand for energy from here. The global population continues to grow. Our energy consumption continues to grow. Even per capita energy use continues to grow, even if oil use does not. So if all of this renewable investment and alternative energy coming to market meets incremental demand, the baseload demand that oil, gas, coal, and other traditional fuels have been meeting will still need to be met by those solutions, and that baseload will continue to grow as well. And if you look at the policy statements from governments around the world, there are some countries that want to be out of this space by 2040. There are other countries that expect to still be in this space in 2050 and 2060, including India, of course. So, I think we see oil demand being strong for a long time to come, which is why it's important to introduce innovations in technology to help decarbonize the traditional fuel streams and offset whatever can't be decarbonized. The conversation around hydrocarbons has to get smarter around how do you decarbonize that solution and offset what remains, not how do you eliminate it, because that won't happen in our lifetime.
Okay, well, let's look more immediately then. You looked at peak oil demand and how that transition is going to occur over the next 10, 20 years. Let's look at next year, 2023. Let's make the assumption that we'll have the Russia-Ukraine war going on. Would you think we're going to have as wide a range in the oil price as we saw this year, between 60 and 130? at different points. Obviously, that's quite a range. We've kind of seen it stabilize over the last 2-3 months. Next year, what impact and what factors do you think could take us out of the stable range?
Yeah, so we've been calling from our research and analytics teams, we've been calling at oil prices being around $80 a barrel by the end of 2023. And that shouldn't be taken to mean that we think the market's going to be stable between now and then. I mean, in reference to the storage and capacity discussion earlier, the fact that there's now a little bit of extra supply capacity, actually helps keep the headline crude oil prices a little more stable going forward. But there's plenty of events that could happen that could create massive volatility in both crude pricing specifically and commodity pricing more generally, including, let's hope for an end to the war in Ukraine. If that was to happen, that would actually have a disproportionate sized impact on the price of these commodities, perhaps to the downside. An escalation of the war in Ukraine could potentially create a monumental upside move in some of these prices. The price of most commodities moved up by about 20 or 30% after the invasion. It could easily do the same again if there was a significant escalation in the form of tactical nuclear warfare or anything else that gets talked about in people who study the progress of the war in Ukraine. So just the war in Ukraine itself could lead to a swing of 30% up or down in prices or more at this point. We think it'll be a very, very volatile road between here and the end of next year, but we end up fundamentally from a supply demand perspective being in a very similar place.
Okay, well, thanks very much, Dave Ernsberger from S&P Global Commodity Insights. I'm afraid we've run out of time on the halftime talk interview today, but thank you so much for joining us.
Thank you, Diala. It's always a pleasure.